the 3rd of March. Hope you're all well. Just a quick recap then of yesterday, and there's a couple of points to have a look at this morning. I've had a few questions, so we'll try and address those in the briefing as well. So, quite an interesting day yesterday in regards to where really equities finished. The S&P down 0.6, Nasdaq down 0.5, Dow down a similar margin. So one of the bigger down days we've had in some time, I should say. And really a fairly quiet session after we had that big run kind of midweek when post the kind of almost euphoric mood from the presidential speech from Trump, that move through 21,000 in the Dow. We're back below there now. And in fact, in terms of the Dow, it closed pretty much bang on the handle, 21,002. It's quite typical, actually, of what you tend to see, I guess, from more of a behavioural point of view. And what you had on Wednesday was this kind of almost psychological want to push prices to a certain level, just because we're close to it almost. Although, yes, Trump didn't have much details, but people were enjoying the fact that he was staying to a more of a predefined script in a presidential manner as a positive. Certainly that acted as a catalyst, but it was almost if we were just short of those levels, we continued to punch higher. When we broke it, we saw a bit of an extension in the various indices. Then normally what happens, and this is quite a common thing in the market that you tend to see when these big levels get taken out, was that it was such a focal point for all asset classes, regardless of what you were trading and irrespective of stocks, is that the following day it tends to be like almost pent-up frustration, and then the market kind of takes a bit of a breather. And that's pretty much what happened yesterday. You had that really big move on Wednesday, much bigger volumes, and then yesterday it kind of petered out and you had some profit taking off those initial highs. Really, there wasn't much more to it than that. Layering in, though, you were still getting a lot of dollar movement. Obviously, everyone is still talking about the Fed. Given the swift change in language that we've seen, this time last week, we were pricing in a March interest rate hike at 40%. This morning, that number is now 90%. Now, that's a phenomenal change in interest rate expectations when we're only, 12 days away from the Fed decision. And one of the biggest things, I think, as we were talking about here yesterday, was those comments from Brainard, who typically is the most dovish member, has always been kind of the last person to switch, if you like, to the hawkish camp. But she did do that yesterday. And so as such, that's what's bumped it up another 10% from when we were talking yesterday. We're going to talk about the Fed speakers again shortly. Because today is a very important day. There's a whole slew of Fed speak, including the Fed chair, Janet Yellen. But just to get you quickly up to speed with a couple of headlines that have come out, firstly from an overnight perspective in China, where you have had the Caixin China services gauge point to a softer February growth. So the service sector in China indicated growth slowed further last month, contrasting with the pickup that we've had in manufacturing. Business activity for service providers grew at the slowest pace in 4 months in February. Now, this is quite an interesting trend, actually, because the service, ultimately, China is developing into more tilting towards services, where it's always been so heavily dominated by manufacturing. As the middle class become more affluent through infrastructure and technology, the affluency of people on a mass scale is meaning that the service sector is definitely something to watch in the longer run for China. But what you're seeing here is a bit of a divergence between the two indicators at the moment, particularly with the data we had earlier in the week on the manufacturing side, which saw a minor uptick, almost the opposite happening. Again, it was the slowest paced in 4 months from the services sector in China. This is from the private Caixin reading as well. Now, that didn't really have too much of an impact overnight. The general tone in Asia was negative, and as such, then you've had a lower open this morning. You can see the DAX on your charts probably this morning already gapped down to find a kind of neutral spot for the time being, sat right on that 12,000 level. But for China, this is also an interesting time. Some of you might not be aware, if you haven't traded for too long, is that on Sunday the National People's Congress meeting is due to kick off in China. Quite interestingly, that's when Will and Pierce are going to China. I'm not sure whether they've got the Premier's invitation from Li Ka-ching to present their proposals. But this is a really big event for China because there's a very close inherent tie between the Chinese government and the central bank. Although in Western world we try to clearly state their independency, in China it's a little bit more intertwined. And this is a really big deal because basically what happens is the Premier outlines his economic targets, proposals and agenda going forward. So when you're looking for things like what's the growth GDP estimate for China, what's the target that they're looking at, these will all get outlined in the coming days. So something to just be aware of. The other thing overnight in Asia, just quickly so you're aware of, because it was statistically an anomaly almost, was that Japan core consumer prices see their first growth in 12 months. So albeit barely, for the first time since December 2015, last month, we've had a slight movement here in inflation on the Japanese core consumer price index. Just looking at the yen this morning, if I just flick my charts over, dollar yen, on a slightly longer time frame. I guess it's 114 psychologically, we're just sitting above that handle. You can see I've got it kind of marked close to it at 114.04. That was kind of marries up with the that high that we had on the 12th of February. So some quite interesting levels here. That was also the high that was seen more recently on the 1st of March. 114, interesting level just to keep an eye on. At the moment it's provided support thus far. But obviously with risk sentiment being a predominant driver, it'll be something to keep an eye on, particularly if the Fed communication gets mismanaged and equities at these more elevated levels come under some selling pressure, and that sparks a more flight to quality type bid scenario, then certainly that breaking of that technical level as well could contribute to some downside in dollar yen today. Okay, some other things to be aware of, and some questions I've already had this morning is talking about France, because the headlines kind of read along this line. French Republicans abandon Francois Fillon as Alain Juppé is seen ready. So the situation here is that more than 60 politicians say that they can no longer support Fillon. I was reading about, again last night, his home getting raided, this investigation about nearly £1 million worth of illegitimate kind of jobs that didn't exist that he paid to his wife and his family, has really seen his woes deepen, and his popularity, not just publicly but within his own party, has decreased substantially. Now, he gave that speech just a day or so ago where, under immense political pressure, he delivered that press conference and said that he would continue to run. Now, I still think that seems logical, in an essence that we've still got quite a few weeks to go until the actual first and second round at the end of April, beginning of May of the French election. But if he continues to come under pressure, I'm sure now that his internal party are starting to turn against him to a quite a large number, then the logical step then should mean that what happens is the party continues on, it just comes under a different leadership. So Alain Juppé, who is also a former prime minister, who was defeated by Fillon in the Republican primary, basically will just come back to the fore and run the party in the race going into the kind of voting election day. According to Juppé, he has spoken in Le Parisien newspaper this morning and has told friends apparently that he's ready for a comeback if deemed necessary. So I would imagine that there's a fairly high likelihood of this now occurring, given the fact that now it's internal conflict that's probably going to force Fillon to the sidelines. question mark then is, what does this mean? How do I trade it in the event that Juppé becomes now the head of the centre-right in the running? How does this then affect Le Pen's chances? Now, this is one of the things that I saw yesterday. This is basically odds checker average probability, implied probability from betting odds. And what you're looking at here is really the last 2 weeks period, where you can see very large fluctuation in the odds, the betting money of where the likelihood of who's going to come victorious. And you can see actually Le Pen has been pretty steady, hasn't really moved at all. And the one thing here is that she's also had her allegations thrown at her, but she's managed to navigate those without any real impact really, either in the polls or in the betting odds. However, you can see Fillon's dropped substantially over the latter half of February to where we are at the moment. At the same time of the allegations almost intensifying for Fillon, the opposite has happened for Macron, where he's had the ability to form a centrist alliance with various backing of previous former and senior politicians from a variety of different backgrounds, which has given him a big boost. And we've seen that apparent in things like the Opinion Way poll, where the difference now I think is 26 percentage points. Remember that during Brexit, I think the margin of error across the poll average in the week into the referendum was something like 6.2 percentage points. Le Pen needs to turn around a 26 percentage point difference. Hence why most people think that it is extremely unlikely that Le Pen's going to win. Also, the 2-round format, which we've discussed before, and so on and so forth. Now, would Juppé completely turn the odds in terms of the centre-right party and see that odd come fighting back? I personally think it will to a small degree, but not enough to influence the fact that the French election at this point will be defined by not Juppé or Fillon. It will be a Macron-Le Pen runoff. I think with the information at hand at the moment, that's what it's telling you. So I don't think that really there's much of a Euro trade, so to speak, on the back of the changing of Alain Juppé taking over from Fillon. I don't think that's going to create, let's say, a Euro buy opportunity, because the gap between Macron and Fillon is just so wide at the moment. In fact, let me just get up the latest Opinion Way poll and we can have a quick look at how that stands at the moment. So, looking at the first round here, you can see Le Pen 25, Macron 23, the two at the top. And actually, in the polls as of yesterday, Fillon's just been basically going sideways. Now, could that creep up? I guess it's not too much of a percentage difference to go into the runoff. But from a personal point of view, if you were a voting public, I mean, how would you feel about supporting a party that's come under such criticism, that's seen very short-termist changes in its leadership? These things tend to lead to more uncertainty, where people prefer continuity in those times, which makes me think that more likely or not, then they would feel more comfortable with someone like Macron, who isn't just Macron anymore. He's got about 3 other senior politicians who are all formed in an alliance under his own leadership then, which captures a bigger contingent, or a bigger net, if you like, of the voting public. So I don't think it's going to make much of a difference, is what I'm saying, I think, at this point. Looking at some of the other things, though, that I've been looking at this morning, and it's all really to do with the Fed. Looking at the calendar today, I'll go back to the UK number shortly, but the whole session today is really defined not by economic data. This is from a broader macro perspective at least. It's defined by Fed commentary. Now, you can see here you've got Fed's Evans, Fed's Lacker, Fed's Powell, Fed's Yellen, Fed's Fisher. They're all speaking today. And they're all speaking today for the very reason that we start to go into the blackout period, which is the period of a week before the interest rate meeting, which is a 2-day event the Fed will be holding on March 14th and 15th. They cannot speak to the press. Therefore, it's zero commentary from any Fed member. So, what do you do as the Federal Reserve? You want to communicate to the market exactly what your intentions are in order to mitigate market volatility. You want the market to be best positioned in order to maintain your mandate of price stability, is what their objective is. Now, obviously, we're in a period of moving interest rates from point A to point B. Therefore, the market needs to be prepared for that. That's why you've had every Fed speaker thus far, including the important one, Brainard, midweek, turning hawkish. That's what's led to this 40 to 90% repricing in the market. Now, the interesting thing here is that Fed's Yellen really holds the key, if you like, because Yellen, by nature and what history has told us, is that she tends to err on being kind of center-leaning dovish, is her kind of natural state. Very cautious, gradual, tends to be her kind of mantra. But given the hawkishness of the members heard so far, she has to walk an exceptionally narrow path here of managing market expectations. Because with March at 90%, the market's already started to price in June for a hike as well. So if she's too hawkish, that might then mean that it gives the signal that not only are the Fed going to hike in March, that they're going to hike in March and they're going to hike in June. Now, that's a complete turnaround of some of the conversations we were having only a couple of weeks ago. If you think about the way that equities have been so supported in the US, a large majority of that, yes, is the Trump trade, if you like. However, it's this slow, gradual Fed return of rate normalization, if you like, which has helped prop up the equity market as well. If that disappears and equities are at these overstretched, overvalued 21,000, 2,400 and in the Dow and S&P, it could get very interesting very quickly if this isn't managed well. An overtly hawkish delivery, I think, will hurt equities at this point. Because if you look at history, and if I show you here, this is US Fed funds rate going back to the 1980s. Now, if you think about the monetary policy lectures we would have given you at the beginning of your programs, that we're in a very unique period in monetary policy, in that we've had a prolonged period that has never been seen before, as you can see defined by this graphic, of no interest rate movement, ZIRP, zero interest rate policies. And that wasn't just the Fed, that was global. Then what you've had is a small fractional blip in December of 2015, a whole year of nothing, and then another blip in December 2016. Now this is very unusual. This is the new norm, if you like. Previously, what would regularly happen with interest rates, as you can see here, going into the 90s, when a central bank lifts interest rates, typically by definition of history, it tends to be the beginning of a cycle of interest rates. You can see that incremental step approach here. You can see it again, very quick to cut rates, because this is normally in response to economic stress or a financial crisis. Then you can see the return here, going into the early, from 2000, 2001, 2002, when I kind of came into the markets as a junior, we were going up 25 basis points, 25, 25, 25, 25, every month. It was almost like, you could almost, for me as a squawker, if we were being a bit cheeky and we wanted to sound super quick, I would even say hike 25 before it even came out. just because it was so certain that that was going to happen. Whereas now what's happening is that, yeah, like Will said, very high risk, but being fast was what my game was all about at that point. But the point being here is that we've had a very, very slow, gradual, incremental return to normality in rates. Now, what might happen is if Yellen is too hawkish and the market perceives it, that we're going to get a March, June, September, December hike. We're talking about, don't forget, we only hiked in December. So that's 1, March 2, June 3, September 4, December 5. We were talking about one rate hike not long ago. We were talking about how the Fed always underdelivers. That's how the market is positioned. Remember, Fed trajectory of rates is like that. It's it's more steeper. It's 3 for the year, but the market always prices itself much more dovishly underneath them. This is almost a flip completely. And obviously things like equities, that's an environment which they've not seen really for a very long time. It's almost like pulling the punch bowl away too quickly could be detrimental, I think. And so she's got a very tough task today to balance it, which is why I think I don't think she's going to be as hawkish as the others, but I do think she will sound like March can definitely go ahead. I think she's going to be a little bit more even-handed with her delivery as to not let the market get too carried away with this being the beginning of a series of hikes, and that they'll just continue to digest, reevaluate at each meeting being a live one, and when they've got more details at Trump, they will also be better informed as to the trajectory going forward. So Fed speakers are absolutely critical today. That's almost probably going to be the most market moving for the assets you're trading. Don't forget, time-wise, 3:15 is the first one. Fed's Evans and Lacker. You've then got Powell at 5:15. Then Yellen doesn't come actually until 6 p.m. London time. She's also speaking alongside or at the same time as Fed Vice Chair Fisher. One thing to keep in mind is if the market does misinterpret, or at least to how the Fed feel of what everyone says today, in particular Janet Yellen, there still is some time for some weekend snap kind of press headlines that could come out to readdress that balance if they feel it's been mismanaged. So, big day today on the speaker front. Make sure you are tuned in for all those points this afternoon. Possibly then, from a broader market perspective, given the outright focus on interest rates now that Trump has already spoken and the needle's almost moved towards the Fed, that despite the brief volatility you're likely to see around the UK service PMI number, ultimately the bigger market direction might not come until actually much later. Okay, quick look at the service PMI though for the UK, which was this number here. This of course is the key figure for the UK. We've had the manufacturing and the construction number was yesterday, but obviously a service-driven economy, this is the number that we care about the most, and therefore default will have the biggest potential market impact on the currency pair. This figure though, at previous reading of 54.5, did miss expectations last time, and it was a fairly big miss. 54.5 against 55.8. It was the slowest reading since October of last year. And so what you're looking out for, and this going forward, is really this chart can go one of two ways. Now, if you remember earlier this week, we had UK consumer confidence figures. They showed consumer confidence continues to fall in the UK. Inflation also continues to rise in the UK. That means net result pressure on household incomes, which obviously is to the detriment of their confidence and then their spending power, and then to knock-on effect, the service industry gets impacted. So what I'm interested to see here is we saw a fairly big drop-off last month and a figure quite a bit lower than expected. What is the pace of this if this is a trend of declining now going forward. That argument that actually Brexit hasn't even technically occurred yet, and that inflation is on the up and is going to go at least 1% higher than where it is at the moment. And if consumers are getting nervous already, then you would imagine that this data should deteriorate going forward, as much as Sam North might make you think the opposite. Okay, that's pretty much all the key things then you're looking out for today. So I would say you might not get too much out of the morning session. It's very US oriented at the moment. There's going to be a short-term focus on that UK figure coming out in about half an hour's time. Keeping in context of where cable has been trading throughout the week, it generally has been trending lower amid some of the movement that we've had from the House of Lords sending an amendment and it having to now go back to the House of Commons, which ultimately doesn't disrupt the final timeline of end of March for the government, but it just adds another layer of formalities to go through, and that has created a slight degree of nervousness in combination with the resurgent dollar on the Fed hike pricing has put cable on the back foot. So a weak number here. We're sitting just off those lows at the moment that we've had more recently, but below here, really the beginning of the year, when we opened up on the 3rd of January, we kind of hit that low in cable. That was that end of December of 2016 level, around 122.17. We're trading at 58 this morning. So some key levels there to just keep an eye on the downside should we see a weak number coming up this morning. Okay guys, enjoy your session. See you in the chat room and have a good weekend.